Joining us this morning is Bespoke's co-founder, Paul Hickey, to discuss. Paul, let's get the fall started. Good to have you. Talk about September seasonality and whether or not there are elements that might make this particular round of September maybe a little less than feared.
Yes, I mean, September, we all know it's historically a weak time of year for the markets overall. Especially, look at what we've done the last 4 months. We're up 1% 4 months in a row. Coming back, that we're in an overbought market, so it's not surprising to see some weakness this month as investors reassess things and come back to reality, so to speak. But if you look back historically at these positive summers, more than 1% 4 months in a row, September was mixed. The rest of the year was continued higher. So I think if we do see a hiccup in September, it should be met with buying. September is historically, the weakness is back end loaded. You tend to see the weakest part of the month right towards the end of the month. As late as September 20th on an average basis, September is actually a positive month. So in that respect, I think that'll line up perfectly with coming up with the Fed later on this month, how that plays out, and could be a catalyst for weakness if they don't give the markets what the market wants.
Yes. People sharing some 10-year charts of the Russell today, where we're getting into that neighborhood that we've knocked on the door on a couple of times since early 21. Do you think the theme of September will be about continued broadening or safety in the tech trade?
I think we'll see some broadening here. We came within like a point of the record high last fall, going back to, but last Friday went into second place for the longest streak the Russell's ever had without making a new high. That follows the Jackson Hole day, where we saw an enormous breadth, some of the strongest breadth that we've seen in small caps on record in a single day. And as long as rates at the long end of the curve, say the 10-year, remain contained, I think the broadening trade is intact. So if you stay under 450 on the 10-year yield, I think you can see the broadening small caps do well in that environment. As far as rates seeing a little bit of an uptick here, U.S. yields versus the rest of the world, they've been so contained in the U.S. versus the rest of the world. So that whole U.S. exceptionalism losing its luster, that whole idea, I think, is going out the window as we're starting to see stocks do better in the second quarter versus Europe, and interest rates holding up a lot better.
Well, you said it all hinges on treasuries behaving themselves. So my question is on that. So interestingly, treasuries are selling off today. Yields are higher. Nothing spiking, nothing dramatic. But there is this idea out there. So the Court of Appeal shoots down President Trump's reciprocal tariffs, and whether that might actually be bond negative because of the fiscal concerns, the fact that tariffs were actually starting to raise a lot of money and be very positive for the bond market. It's not what we thought going in, but is that what's happening?
Yeah, so suddenly tariffs going away would be a bad thing. It's this market, things constantly change. The narrative constantly changes. I think, that could be a potential negative. Whether or not that happens, we still have the courts to go through with this. And if the Supreme Court doesn't uphold the tariffs, then you go into Congress. So there's still a lot to be played out. But yes, Sarah, if you do start to see that tariff revenue, not materialize, it would create a tenuous budget situation. But again, U.S. yields are holding up a lot better today versus the rest of the world, and so that's not the only thing going on in the treasury markets around the world right now.
Yeah, 30-year gilts in the UK highest since '98 today.
Yeah.
We definitely don't have quite
Amazing.
that problem here.